Hi everybody, it's AJ speaking. At the moment we are only 2 weeks away from third quarter of 2025 deliveries. At this point in time, it's always a good idea to review how Tesla typically trades so prior to deliveries announcement, upon delivery announcement. But then also we look at how Tesla trades before earnings announcement and upon earnings announcement. And what we're going to do is we review the last 10 quarters to see, to basically refresh our memories. So let me just explain real quick how this chart works. You don't see share prices here. Share prices have always been rebased to the share price 10 days prior to the event. And we're looking at the two events that are deliveries and earnings. And rebasing means you express all other share prices as a percent of that fixed share price. So in other words, you see here down in the scale T minus 10, T minus 9, T0. So T0 is the first share price or closing share price when the market knows about the data that Tesla released. So for example, Tesla releases deliveries in pre-market hours. So T0, so the share price that reflects knowledge of deliveries is that day. However, when it comes to earnings, so this is this dark blue line or teal color, T0 is actually the closing price on the next day because Tesla reports earnings in after hours. And all share prices are expressed based on the share price 10 days out. So why 10 days out? When we talk about deliveries 10 days before a deliveries announcement, the market has a pretty good idea where Tesla comes out. The margin of error is actually relatively small at that point. And the primary reason is that the largest market, China, or one of the largest market, depends on the quarter really, reports weekly. For the second largest market or sometimes the largest market, United States, the first 2 months of the quarter have been reported, and there's usually more data to come up with a view on sales. And on top of that, other important markets also have provided significant data. So the long story short, at that point in time, deliveries are significantly locked in. However, it doesn't mean that there's a surprise potential. And then the same logic applies to earnings. After Tesla reported deliveries and energy storage deployments, the estimation error for earnings per share and other important metrics tends to be quite small. So with that out of the way, let's start with the oldest quarter in this analysis. It's the first quarter of 2023, and I will go through the older quarters quite quickly. So this light blue line, again, the deliveries. 10 days prior to deliveries, the Tesla traded up and was up about 13% compared to 10 days prior, immediately before the deliveries were released. But then upon release of deliveries on that day, sold off around 8%. Then in the 10 tradings prior to earnings, so first quarter of 2023 earnings, stock traded mostly sideways, but just in the last 2 trading days, then sold off a little bit, and then on release of Q1 numbers, dropped quite substantially, roughly almost 10%. The primary reason was that margins came down meaningfully. Then in the second quarter of 2023, deliveries announcement caused a significant spike in the share price, stock trade up around 7%. Then later earnings, however, disappointed, stock sold off roughly 10% on further weakening margins. You can see here Tesla managed to surprise in terms of deliveries. Then the third quarter of 2023, deliveries came in line. That speaks to my argument that late in the quarter the market has a pretty good view on where deliveries come in. But then because of the global price war in automotive primarily, margin weakened further. Stock then sold off on release of the Q3 results. Stock dropped by roughly 8-9%. Then Q4 2023 came around. Deliveries were in line, so therefore no major reaction in the share price. But then a couple of weeks later, when Q4 results were announced, the market was quite disappointed by Tesla not providing 2024 guidance. Stock sold off over 10%. Then Q1 2024 came around, prior to deliveries, stock traded kind of neutral sideways, but then sold off roughly 5% on deliveries miss. There were a number of one-off items, the arson attack in Berlin, there was the Houthi attacks causing the Suez Canal to be closed, causing a second shutdown of Berlin, a bunch of other things, local supply-demand mismatch. There was a quarter loaded with significant one-off effects in the auto business. And because deliveries, because of these one-off effects, decreased significantly, the financials were expected to come in quite low. And you can see how the stock sold off in the run-up to earnings. Basically, investors pre-position for a tough earnings print. But then Elon saved the call or the announcement day by announcing a lower cost vehicle, and that caused the share price to spike 10%. Then the second quarter of 2024, there was a period of a strong rally for Tesla. That was also a little after Elon's compensation package was approved the second time by shareholders. So that was this period is not driven by deliveries. There was really a recovery rally in Tesla after people were worried Elon would not get his compensation. And then the stock took off over 10% when Tesla reported deliveries. But in that quarter, not deliveries were the key item. It was like truly blockbuster energy storage deployments that took everybody by surprise, as you can see in the share price reaction. Then in the 10 trading days prior to earnings, the stock saw some weakness, but keep in mind that was after quite a substantial rally. And then on earnings announcement, Tesla sold off about 10%, and that was driven by announcing significant restructuring charges. There was the quarter when Tesla was laying off, I think, a record amount of employees, and then earnings were also quite depressed because of the restructuring charges. Then we move on to the third quarter of 2024. So prior to deliveries, Tesla traded up quite nicely, then saw, I would say, modest negative reaction upon release. The street expectation was a bit too bullish, also the Tesla community, but consensus was right on the money. Then we have one, let's call it noisy data point in the run-up to earnings. There was the period right after the We Robot event on August 10th that saw a quite significant sell-off. And then the stock was kind of flat in the subsequent 9 trading days. And then there was a massive spike in the share price. It was like one of Tesla's best days ever. Stock was up about 20%. And the reason was the Q3 of 2024 was a really strong quarter. And the reason for that was there were a number of what turned out to be one-off effects from today's perspective. There were very strong credit sales. There were one-time revenue recognition associated with certain software updates for Cybertruck, certain things related to manufacturing credits in the United States, and just a bunch of other things that overall boosted metrics across the board quite substantially. And that was also a period where Elon provided some guidance. For example, end of August 2024, Elon appeared on a Alex Friedman podcast on which he said that Tesla would certainly do over 100 billion in revenue. That turned out later not to be the case. And on the earnings call, Elon also said on Q3, which also was part of the share price reaction, that Tesla would slightly exceed the 2023 full year total in terms of deliveries. That also did not happen. And then we look at the Q4 of 2024, but here what you have to keep in mind, this was the period after the or during the Trump victory rally where Tesla share price increased to almost $490 per share sometime middle of December of 2024, so just prior to deliveries. So that's why this period is kind of tricky, because it was boosted so much by other themes. But when we look at the trend, so basically there was meaningful volatility in the trading days prior to deliveries, which dropped on the 2nd of January. And then deliveries disappointed, did not meet Elon's guidance. And then we saw a relatively modest sell-off on that realization. I should mention my estimate was right on the money. but I think the prior quarter in Q3 I was off if I remember correctly. But anyways, let's move on to Q1 of this year. So that was interesting. So that was a tricky period. There was the period with all the vandalism against Tesla, and it was quite volatile time period, as you can see here in the last 10 trading days prior to deliveries. Tesla moved up over 20%, then pulled back by over 10%, and then moved up around 6% on deliveries announcement. Interestingly, deliveries missed, but deployments beat. But that data point was kind of muddied by rumors that Elon would be leaving Doge. Elon quickly poured cold water onto that rumor, saying this was not true. But only a couple of weeks later, he confirmed that he would be leaving Doge. So I think it's always good to remember these things that things said at one point may not be true forever. People change their minds, and Elon is no exception. Then when we look at the 10 trading weeks prior to earnings for Q1, there was also quite a bit of volatility, but there was one exceptional event. There was one of the best overall stock market trading days in history. And as part of that, Tesla obviously also soared just like pretty much every other stock. And that was when Trump announced the 90-day tariff truce with China. And then that earnings call was also perceived positively, and this was also a situation where earnings missed, but Elon saved the day by making an announcement that changed the narrative. So Elon announced that he would be leaving Doge, and he would be spending more time at Tesla and his other ventures. That narrative then quickly took over and overshadowed the earnings miss. And that ultimately then offset the earnings miss and drove a positive reaction in share price. So we see a interesting pattern. So when earnings look not so great, Elon typically finds a way to prevent the worst. And that is basically a hallmark of a great CEO. Sure, some of you might be listening to this and say, oh, but this is perhaps a little dodgy. But ultimately, from a shareholder's perspective, you want a CEO that is flexible enough to find ways to mitigate potentially very negative share price reactions. Of course, many will now say, but there were certain posts that caused a negative share price reaction. Yes, that's true, but nobody is perfect. Then last, we look at second quarter of 2025. A stock saw kind of a mixed trading in the 10 days prior to deliveries. First move up by 10%, and then basically lost all the gains and actually was down 5% relative to 10 days out. And then there was a positive reaction on announcement of deliveries. Wall Street was actually right on the money, and Tesla delivered ahead of what the community and also the street expected. So most people expected lower sales, yours truly included. But what saved what saved that quarter in terms of deliveries was a better than expected US performance, and also exceptional performance in certain overseas market like South Korea and Turkey. So you might be sitting there now and ask, okay, so what? So now we get to the so what. So when we look at this analysis, first let's focus on deliveries. If you stayed out in Q1, 10 days out from the stock, you lost about 6% returns. In the second quarter, if you stayed out ahead of deliveries, you lost also roughly 7-8%. In the third quarter, getting out around 10 days prior, you were 5% better off. In the fourth quarter, didn't make too much of a difference. You were better off around 2-3%. In the first quarter of 2024, now we move on to next year, you were better off by around about 5%. In the second quarter of 2024, this was the rally period. Getting out before deliveries was a terrible idea. You would have been down 25%, but keep in mind, this was quite exceptional quarter in many ways, as we just discussed. Then in the third quarter of 2024, getting out 10 days prior to deliveries was also a bad idea. You were worse of 10%. The fourth quarter of 2024, getting out 10 days prior would have been a pretty good idea. You would have been better off by about 13%. What about 2025? Getting out 10 days prior would have been a really bad idea. You would have been worse off 20%, but keep in mind this was the period where we saw this exceptional market trading day. So if you sorry, that was not the exceptional market, it was for earnings, so cross that what I just said, but there was also quite a massive recovery rally, so I think there's a noisy data point. And then when we look at the second quarter of 2025, it didn't really matter. So if you got out, you basically could enter upon drop where you left. And then we do the same kind of analysis for earnings. So Q1 2023, you should have gotten out, would have made you better off by around 13%. In the second quarter of 2023, also getting out 10 days prior was the right call. You were better off 5%. In the third quarter 2023, getting out was a very good idea. You would have been better off 15%. In the fourth quarter of 2023, same thing. You would have been significantly better off by 23%. Then 2024 first quarter, also getting out 10 days prior was the right call. Second quarter was also the right call. You would have been better off by roughly 17%. Third quarter of 2024, getting out was not the right call. That was the blockbuster quarter. You would have been worse off by almost 10%. But that I've been analyzing Tesla for well over a decade at this point. In the last couple of years, there was really, in terms of performance, quite exceptional outlier because of the cumulative effects of various one-off effects. I don't expect it for the third quarter of this year, unfortunately. Then Q4 2024, getting out was also the right call. You would have been better off by roughly, call it 6%. So what about this year? This year, again, here was the massive market rally, so this data point is a bit noisy. So that truth announcement cost an over 20% spike. So if you mentally adjust for that, and you just think from that point onwards, you didn't lose if you got out in the 8-9 days prior to earnings. And then what about the most recent quarter, second quarter of 2025? Here a similar picture. If you got out ahead of earnings, that was the right decision. You didn't really improve very much because there was a strong buying into earnings. So what's the key takeaway from all of this, or what I said earlier? So what's the so what? The so what is that based on historical trading patterns, in most cases, in the vast majority of cases, investors were better off about 10 days prior to reduce their position temporarily, and then basically buy back after the print. This is not trading advice. You have to make your own decisions in the next couple of weeks, and because we are about 5 weeks away from earnings, there will be a lot more research coming from my side to see whether this quarter is likely such a case. But that analysis I will be posting only on X, where I can't post right now. If you found this informative or helpful in any way, please don't forget to like, share. If there is a lack of interest in this type of research, then there's no point of me sharing it. Thank you very much. Take care. Bye.